All right. Happy Monday. Happy Monday. Bowen. 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 Chisholm. Christian. Madeline. Contreras. Earl. Peter. Hand. Lee. Linders. McClure. Navarro. Impero. Ramos. Carissa Rodriguez and Giovanni Rodriguez. Silvestri. Simpson. York. Van Hinkel. Walker. Wilson. Okay. So we had a nice quiet week last week. I apologize for all this Wednesday. That was a little bit of a shift. Hopefully you had time to review the YouTube videos, which would have been essentially what we would have covered in class. And it'll help you get set up for going forward. What questions do you all have from time value of money, the workup from last week, quizzes on chapters 1 through 4 will we do this week? Nothing. Okay. Well, we'll take nothing. This week, we're going to start focusing on interest rates. And interest rates, if you recall, here in finance, every asset value is driven by two pieces of information, which are time and money. So you've got a series of cash flows and an interest rate. What does the interest rate measure? Risk. So interest rate is a measure of risk, and then you've got your series of cash flows. The combination of a series of cash flows and risk, as expressed by interest rate, You put the two together and they result in an asset valuation. And here in finance, what we're really focused on is asset valuation, the difference between making a decision given those two pieces of information. So I'm going to start with a little definition of realized return. Yes, ma'am. Chapter 5. And maybe a little different than what you.
Because there's 1, 5, and 6, and there's 5 and 6. So that's what I was wondering.
Oh, it's just 5. There's going to be, yeah, if you have a 5 and 6, it'll be at the front end of the 5 and 6. I want to start with realized return. And I'm starting with realized return because it gives a perspective of how you get your money back on any given piece of financial asset or any given financial asset. So you've got a yield, and you're going to see problems where they ask you to calculate the yield on something. And we talked. I'm getting my two sections mixed up, I think. We may not have talked, but we're going to talk about yield in terms of you're going to see problems and say, what's the yield on? And yield is comprised of two parts. It's comprised of the dollar return, the dollar income, and the capital gains. And sometimes you want to try and figure out which is which, and other times we tend to ignore, particularly in the case of a bond or other financial asset that looks like it's a relatively steady stream of cash flows over time, we tend to ignore or forget about the capital gains piece. And so when you look at the yield on an asset, you've got the dollar income. What do you think that would represent? If this is a bond, what would the dollar income be? Interest. If this is a stock, what would dollar income be? Dividends. If this is a piece of real estate, what would your dollar income be? Probably your net income, so rent minus expenses. And then you've got the capital gain, ending value minus beginning value. If this is a piece of real property, if this is an apartment complex, what would that be? How many folks would buy an apartment complex and not expect the value to go up over time? And this is the easiest kind of thought about in terms of something like a piece of real property, an apartment complex. So you've got your net income off the apartments, right? So you buy this apartment complex, a 20-plex or something, or even a duplex. You go, okay, I'm going to get rental income minus expenses. That's my dollar income. Then I've got an ending value. So I say in 10 years, I'm going to sell it for $200,000. I bought it for $100,000 today. The yield on that investment is a factor of the income over time plus the change in value in the underlying asset. When you think about something like an apartment complex, it's relatively easy to wrap your head around that. You go, okay, well, it gives me rent every month minus expenses, and then it goes up in value. And so when I sell it, my yield for the time I've owned it is the dollar income I received over the change in value divided by the $100,000 I spent to buy it. And that's really your total return, your total realized return on that investment. It's not just the money you're making every month, and it's not just the gain that you had here. If you had losses, it would pull, so if your expenses exceeded your rental income, it would pull that yield down. So it's important as we start looking at things like interest rates and asset values that when you hear the word yield, you don't say yield equals interest rate. Yield is really a measure of, it's a percentage. It looks like the interest rate, but it's really a measure of what the return was. The interest rate is a measure of what you expect the return to be based upon the risk factors. And there's likely to be a difference. Any questions on this concept? Biggest thing to keep in mind is yield is composed of two parts, your periodic cash flows and then the capital gains. And again, you may be asked to calculate one, the other, or both. So let's talk about factors that impact the cost of money. The cost of money is another way of describing interest rate. It's the amount that you're going to have to pay to borrow money or to put money to use. And it's factored on these four items. And we've talked about this as we've discussed in class. Things start coming up and people go, well, if I need the money more now. And I said, where does that get factored in? Interest rate, time preferences for consumption. If I want it now versus later, that gets factored into the interest rate. Production opportunities. I'd rather do this with it than that with it. That's factored into the interest rate. Risk is factored into the interest rate. It is essentially the penultimate measure of risk is the interest rate. And then inflation. What's inflation? Prices go up over time. In a normal economic cycle, we see a relatively small rate of inflation. The Federal Reserve, the U.S. Federal Reserve, targets a rate of inflation of around 2 to 2.5% per year, which allows the money supply to continue to grow, allows the economy to continue to grow. If the economy gets overheated, if the economy grows too quickly, what happens to inflation? It runs away, it goes up, because supply is lower than demand. And so prices start rising rapidly. So if you look at housing prices in Seattle, for instance, it's seeing high rates of inflation in housing prices. If there's a recession, what happens to inflation? Why?
Because there isn't enough money to sustain for anyone to even be able to sell it.
Yeah, so what you see is supply outstrips demand, and so prices start to fall. As a matter of fact, in some cases, when the economy is really bad, you see deflation. You see, and we saw this in 2008. You see housing prices start to fall. You see other asset prices start to fall. You see stock and bond prices start to fall. You see the price of food starts to fall. You also see deflation driven by technology. So the prices of computers. When I was 10 years old, we got our first personal computer. It was an IBM. It was really cool. It had 2 disk drives, big floppy ones. It cost like $3,000. This is $3,000 in 1984 money, which would be the equivalent of about $14,000 today. That same computer isn't good for a doorstop today. And an equivalent computer, one like you sits on this desktop here, you can buy for about $400. So you see deflation can be driven not only by economic factors, but also by technology factors as well. Cars were the same way. When you think back to the cost of a new car, they've actually stayed pretty steady over time, although the cars have improved dramatically from 1912 to 2018. So these are the 4 factors that get put into the cost of money to derive the interest rate. Essentially, each one of these is a measure of risk. Risk is called out here as a separate one because it's risk, and we're going to talk about the various risk factors that comprise risk in this definition. But each one of these is really, when you think about it, a risk factor. The risk of prices changing, the risk of delaying, the risk of choosing the wrong thing. So when you think about interest rate and you equate it to risk, you're not only including the definition of risk that the book gives, but these are all components of risk as well, and it's easiest to keep it in that frame. You'll find that I like to talk economics. I like economics because it explains things in a relatively straightforward manner. Economics is not a straightforward discipline, and I'm hoping do I have any economics minors in here? No? Tragic. Economics is, if you begin to understand economics, I would encourage you to take a few economics courses beyond just the basics, because a lot of the policy that's driven, at the governmental levels, once you get out of here, explanations of behavior as it pertains to choice and limitations of resources are driven by economic theory. And so when you hear me talk, you guys tend to explain things in terms of example. And you'll hear me tend to explain things in terms of supply and demand. So I will tend to say demand rises, demand falls. Supply rises, supply falls, because I studied economics. And so when you look at supply and demand and interest rates, what ends up happening is if you have a low risk security, you've got a supply of low risk securities, and you've got a required rate of return. So it says, okay, the required rate of return is 6, given these dollars. If risk changes, if your preference for risk changes, you see a shift in the demand curve. So when demand goes up, it'll shift to the left. And what ends up happening then is the required rate of return will drop. So as people start to get more and more concerned about a risk profile, or they start going, okay, I want to trade off, I want less risk, you'll see demand for less risky assets will shift. The required interest rate starts to fall. So when you're looking at things in the market, for instance, and you're monitoring, because you like to do this kind of stuff because you're in finance class, you're monitoring things like stock rates, the stock exchange or bond rates, or the Fed funds rate, or the prime rate, and you start seeing these things go up and down, what you're seeing is also a function of risk tolerance. This is a high risk security. You'll see that there's a supply and demand function, and it says the required rate is 9%. In each one of these cases, you can tell the risk level based upon the required rate of return. That's going to provide you with the supply. The demand is going to be market demand for that high rate of return, or for that specific risk level. It translates into a rate of return. That's where interest becomes a proxy for risk, or a measure of risk. When we look at shifts in market demand or shifts in market requirements, you'll see changes in this required rate of return. A lot of what has been explained by the things like the big run up in real estate rates or real estate prices in Seattle is a shift, essentially. So let's call real estate a high risk asset. It's traditionally not. What you've seen is a shift in demand. So interest rate, the required rate of return starts to drop. What do you think that does to an asset price? If the discount rate or the rate of return drops, kind of going back to chapter 4 and time value of money, the interest rate drops, what happens to the asset value? Less valuable, or?
It's more attractive to buy, but the return you get on it is lower because it's a safer investment.
So if you have, we'll do a little.
Doesn't it just drop? Because if you're going to get less out of the asset, you're going to pay less for it.
Yeah, so here's the deal. If you've got $100 and your required rate of return is 10%, or you've got $100 and your required rate of return is 5%, you've got something that's going to give you $100. We'll call it a perpetuity because it's easy math. So it's a $100 perpetuity. The required rate of return is 10%. How much is that? How much is the value of that perpetuity? Say again, louder. It's 1,000. So on a perpetuity, your cash flow over the required rate of return, 100 over 0.1 equals 1,000. So if the interest rate, required rate drops because demand shifts, and the required rate drops from 10 to 5, what's the cash flow? Did the cash flow change? No, cash flow is still 100. What's the required rate of return? 0.05. So what's the value of that asset? 2,000. So when you have a shift in demand because the market says they're willing to take more risk, or they've got a higher risk tolerance, what happens to the value of the asset? It goes up. So one of the things to keep in mind as you're looking at financial assets is when you see a shift in a preference, when you see a shift in demand, anything that's going to shift demand this way, demand goes up, prices go up. The required rate of return is expressed in terms of the interest rate goes down, and if required rate of return goes down, prices go up. Prices are always going to go up if the required rate of return goes down. There's an inverse relationship between price and rate of return. It's a relatively simple concept, but it's one that will help you a lot in this course. It'll help you a lot in the real world. As interest rates go down, asset prices go up because the cash flow doesn't change. And so when you look at that simple example in a perpetuity, you're able to see that, okay, as the interest rate dropped, the perpetuity doubled in value. And it makes it easy to kind of understand that as risk tolerance increases, required and demand for a risky asset rises, the required rate of return will fall, the asset price will rise. And that could be a perception in risk. So they may say, hey, real estate in Seattle is less risky. I'm willing to pay more because I expect it to rise in the future. Or that could be a change in tolerance for risk. Here's historical interest rate levels. I'm going to point out, actually, why don't you guys point out a few things for me? You see, shaded areas indicate recessionary periods. Here's inflation. Inflation, we said, was increases in price. This red line is short-term interest rates, which are interest rates for 1 year or less. The blue line is long-term interest rates, 1 year or more. Starts at 1990, which would have been right about the time many of you were beginning to walk, and goes into, get that, and goes up to 2014. What can you tell me, what does this chart tell you about interest rates, about inflation, about the relation between interest rates and inflation, and the business cycle? So you can see these are recessionary periods. So that means the economy is going down. Yes, sir. So do you see any periods of deflation? If this is the inflation measure, do you see any periods of deflation? No, but darn close. Right here in 2008, there's basically no inflation, zero. But what you can say, and so you're on the right track, what you can say is over time, inflation has actually come down. And when inflation has been lowest during these periods of recession, what's happened to short-term interest rates? Short-term interest rates have fallen every time you've seen a recession. Sometimes a little bit ahead of a recession, but always, see this, here you can see it coming down a little bit ahead of the recession, and all of a sudden we went into recession, and then it went and stayed down. Here, a little bit ahead of the recession, you see interest rates start to fall, and then we get a recession. Here, a little bit ahead of the recession, interest rates start to fall, and then we go into recession. Why do you think that is? Yes, sir. So what you're seeing here is the effect of monetary policy, federal monetary policy, which is essentially saying, hey, we're seeing the economy start to slow down. And so we're going to start having the federal funds, or the Federal Reserve starts to reduce the Fed funds rate, or starts to encourage borrowing, which drives interest rates down to try and stimulate the economy ahead of or to mitigate the limit for recession. So what you see is normally when you see the Fed start cutting interest rates, you can anticipate that you are either going into or are in a recession. And you can see once you go into a recession, they cut interest rates pretty aggressively, right? And in each one of these cases, they're like, okay, we've got to drive the economy back up. We've got to drive the economy back up. What happens to inflation after they drop interest rates? Generally, it goes up. Why? People are able to buy more. So talk to me in supply and demand. What ends up happening? You're on the right track. You have excess supply here. You have inventories building. Again, I know we're kind of going back into the dark ages of economics. Inventories start to build. So you have excess supply, less demand. So prices start to fall to try and clear excess inventory. You end up seeing interest rates fall. What does that stimulate? Prices fall, interest rates fall, which stimulates, which is demand. So demand starts going up. Then as demand goes up, what happens to prices? Prices start to rise. Then you'll see prices, this is normal business cycle. When you have a recession, prices tend to fall. So inflation falls, prices fall, the economy stimulates and it goes back up. The reason this is important, there is a couple. As a practical matter, as you are looking at the economic environment in which you or your business is operating, there's some leading indicators that say, hey, we may be running into problems. As inflation starts ticking up, you'll see that they will begin to increase interest rates to try and suppress demand, to try and keep inflation around the inflation target, which is around 3%. Between 2.5% and 3% is the inflation target. So once inflation starts ticking up higher than that, we'll tend to push interest rates up to try and drive inflation back down and drive demand back down. Over time, what's happened to long-term interest rates? Yeah, they've gone, long-term interest rates have come down and have stayed down. Back here in 1980, so 10 years prior to this chart, long-term interest rates were actually about 5 to 7 points higher than that. A mortgage was pushing 17%. So you've seen long-term interest rates continue to decline. What's happened to short-term interest rates over the last 10 years or so? They're low, and they've stayed low. Short-term interest rates, if I drew this out to 2018, they've only just started to tick up. You'll hear on the news, and you'll watch, if you read The Economist or anything, any of those cool magazines like the cool kids do, you'll see that they're talking about the Fed is increasing interest rates, potentially 4 times this year. We haven't increased interest rates, really, short-term interest rates, for almost a decade, and it's starting to tick up. Why do you think the Fed is looking to increase short-term interest rates? The improvement in the economy, and what are they trying to prevent? Yes, they're trying to prevent inflation. So here's what's happening. I'm going to give a little bit of fiscal monetary policy discussion this morning, and then we'll move on. What you're seeing right now is the federal government has recently passed a new spending bill. From a fiscal policy perspective, the federal government is spending more money than it takes in. That's generally called fiscal stimulus. The federal government is spending money. It's spending that money, putting that money in the economy, it's causing the economy to grow. The president's proposed an infrastructure bill, $1.5 trillion infrastructure bill. That's more federal spending in the economy. It'll cause the economy to grow. What does fiscal stimulus tend to cause? Inflation. When the economy grows, you see inflation. So when you see deficit spending, tax cuts, and fiscal stimulus in the terms of infrastructure spending, all 3 of these tend to be stimulative to the economy. And so you see the economy will go kind of push up, and you'll see economic growth driven by those things. The president goes, we'll have economic growth. What he hasn't said is we'll have inflation, and we'll have wage inflation, which is something I think that he's counting on. You'll also start to see price inflation. And what else you'll start to see is what happens when inflation goes up, what happens to short-term interest rates. Short-term interest rates will start to rise. So the Federal Reserve is looking at this situation and going, okay, we're trying to target about a 3% inflation rate. And the federal government is pouring fiscal stimulus into the system. It's pouring tax cuts, it's pouring borrowing, it's borrowing and spending, and it's doing infrastructure spending. So we're going to start raising interest rates to try and tamp down the overheating of the economy. And if you go to the Benedictine reading room upstairs in the library and look at The Economist this week, you'll see that it's got a running hot is the cover, and it talks all about that. Essentially, the challenge that there is between stimulating the economy for growth and having the economy overheat and actually causing something that looks like this, where all of a sudden interest rates really start to rise, and then it drives into a recession. So you see it up and down. Generally, historically, the longer you go in an expansion, the more severe you get a recession. The economy will tend to revert to the mean. And so as a result, it's something to keep your eye on over time. Any questions on this cool chart? You can tell I kind of like it. It's interesting stuff. Okay, let's talk a little bit about interest rates. Interest rates, there's this cool thing called CAPM, Capital Asset Pricing Model. We're going to spend a bunch of time on the capital asset pricing model. I get so excited about the capital asset pricing model that one of my classes bought me a mug that says capital asset pricing model CAPM on it because I wouldn't shut up about CAPM. You are going to get the same benefit without having to buy the mug. So we're going to talk a lot about capital asset pricing model. Capital asset pricing model is something that was developed by a bunch of economists. They earned a Nobel Prize. It's really nifty stuff, and it's relatively simple to understand. And we're going to start touching on it today. So we talk about rate of return, interest rate as being a measure of risk. There's two pieces. And these two pieces move in different ways and have different functions, but it's really how we can measure risk, both systematic risk, so risk that's inherent in the economic system, and non-systematic risk or unsystematic risk, which is risk that's inherent in the specific project or the specific company that we're measuring. And the required rate of return on any given financial asset is a product of those two elements, the risk-free rate of return. And this has become such a commonplace thing that if you get all excited, you can Google risk-free rate of return for a given period. And Google will give you the history of the risk-free rate of return because folks try and calculate this all the time. The risk-free rate of return, so you can see on a low-risk asset, no risk at all the way up to a really risky asset. So let's say this is loaning money to your local mob friends. Right then. What happens to the risk-free rate of return? So if you're loaning money here, low risk, loaning it to the federal government, or you're loaning money here to your brother-in-law or your sister-in-law, what happens to the risk-free rate of return? It stays the same. It doesn't change. The risk-free rate of return doesn't change because it's based upon the system. It's based upon the system, the big picture. It factors in a bunch of these things like inflation and all that, what's going to happen in the future based upon the economy, because that's really, everybody needs to know that, and that's going to drive a portion of the return. Then you've got this premium for risk. What do you think that is? Kind of, sort of, but you're on the right track. Anybody else want to take a shot at that? That's the difference between Uncle Sam and the stepbrother. You're measuring the premium, and you're saying, look, for Uncle Sam, I'll loan him at 1.5%. But if I'm loaning it to your boyfriend or your girlfriend, it's going to be 21%. And if I say this is for easy math, this is 1%, and this is 21%, what's the risk-free rate? 1. What's the risk premium for the girlfriend or boyfriend? 20. So 1, the risk-free rate's the same all the way through it. So if I said I've loaned at a 1% here and 21% here, the risk-free rate is still 1. The risk premium here is 20. And a lot of what we do in finance is trying to should be. Because we can we got to figure out what this is too. This is a little bit easier to figure out. There's consensus for it. Then it's going, okay, how much additional risk is being driven by this particular situation? How much of a premium, how much additional compensation am I going to require to actually do this? And let me stack that on top. And so when you look at any two situations, any two given opportunities to loan money or to invest money, you're going to be able to determine which is riskier by the increase or by the level of premium for risk or risk premium associated with the particular interest rate. Any questions on that? It's a pretty critical concept. So now we're starting to get into the capital asset pricing model. Determinations of market interest rates. The rate of return is almost always put in as R. I'll use R, you use R, most everybody will use R. Sometimes the book uses weird stuff. Where the book uses weird stuff, we'll try and translate that into what the rest of the world uses. The required rate of return is a risk-free rate plus a risk premium. We just saw that graphically, now we're seeing it in the formula. Risk-free rate plus risk premium. The risk premium consists of 3 parts. And if you think about brother-in-law, there's 3 pieces to the risk premium which you would want to take into account. Default risk premium, which is what? He ain't paying you back. Liquidity risk premium, which is what? Not quite.
The possibility of you paying back. How much you said to income. You said to back.
Not quite. No, that's still part of default. Liquidity risk premium is essentially, if I don't want to loan money to brother-in-law anymore, who could step into my shoes? Can I get rid of this asset? And then you've got maturity risk premium, which is what? Looking out over time, what's the chances that I'm going to receive this money over the life of or over the maturity period? So when you look at liquidity premium, here's a simple example. I've got a bond in St. Martin's University, or I've got a bond in IBM. Which one has a higher liquidity risk? Why? Higher liquidity risk, St. Martin's, because I can't sell St. Martin's bonds on the New York Bond Exchange. I could sell IBM bonds. As a matter of fact, I could make a tougher argument and go, which is harder, St. Martin's bonds or the bonds of a nearly bankrupt company? Which one has a higher liquidity risk premium if those bonds are traded on the New York Bond Exchange? And the answer is St. Martin's, because there's no liquidity, there's no market for our bonds. They're privately placed with U.S. Bank, by the way. You can look that up online if you're really curious. But U.S. Bank can't sell them. If it was some nearly bankrupt company, the default risk premium may be much higher, but the liquidity risk premium is going to be lower because at least you can go, okay, screw it, I'm out. I'm going to sell those things. I'll take my loss, but at least I've got liquidity. If it's St. Martin's, I'm riding this thing right to maturity, whether I want to or not. And so you've got these three components of the risk premium, really accounting for time, accounting for the probability of actually getting repaid, and accounting for the ability to get out of the decision and make a different decision. Each one of those creates a risk, and each one of those risk components gets measured and gets factored into the risk premium, which gets added on to the risk-free rate. This is where the book and I start to differ in our terminology, or it's one of the areas where we differ in our terminology. So I'm going to try and use mostly the book's terminology, but if you hear me slip into some of the alternative terminology, raise your hand and ask the question. It's the last piece we're going to cover today, which is the difference between real and nominal rates. Can anyone want to hazard a guess what the difference between a real rate of interest, a real rate of return, and a nominal rate of interest? What's the difference? What's the one thing that's being accounted for differently? Inflation. Which do you think is measured most frequently in the work that we do in finance? Do you think we look mostly at real rates of interest or at nominal rates of interest? At real rates of return or nominal rates of return? Probably nominal. Mr. Chisholm's correct. Probably nominal. The reason, why do you think we look at the nominal rate of interest? Yes, sir.
Because everything we're looking at is based off of what we expect to get.
What we expect. And what do you think is built into the interest rate for what we expect? Interest to include inflation. So really, all these, normally we build into our interest rate the expectation of inflation, the expectation of future inflation. So we tend to measure everything in nominal. And it's far easier to measure things at nominal. Almost everything you see out there is measured at nominal. And you have to back out inflation to figure out what your real interest rate is. Real interest rates become important when you're looking at things like retirement savings. So you're saying, okay, I'm making $35,000 a year today, and I want to be able to make $35,000 a year when I retire at age 70. And so I've got 45 years to go, and I got to figure out how much money I need to save. You can do it one of two ways. You can either go, okay, what's my expectation of inflation going forward? And then what is $35,000, in 45 years going to be? Say $350,000. Okay, now I need to figure out how much I need to save to discount back. Or you could use the real rate of interest or the real return and go, at a real rate of return, I need to save this much every year in order to be able to have $35,000 a year equivalent in 45 years. Or the rate is the nominal rate of any investment, which includes a risk premium. And it says might include, I say it does include, it just maybe the risk premium is 0 for that particular investment. The book uses R-star, which they...
There's a systemic risk involved in a contracting not seen on hand.
Okay.
What do we do?
Just statement. That comes through the... Okay.
I see them.
Let's, if you guys could pull the blinds on the backside there. Oh, there's no blinds on those windows. Yeah. all fun and games here at St. Martin's University today.
People in the hallways are running into it, I have no idea.
Right.
They only say that at night, okay.
Like what?
Well,
Yeah. That's one by the door, right?
Okay, they can see it.
Fortunately, we're a relatively boring location here.